Okay, I think we'll get started. Well, good morning, everybody. Good morning and welcome to Wayland's March 2022 Banking Panel Workshop. For those of you who don't know me, I'm Richard Crabtree. I'm a shareholder and president of Wayland Company CPAs. And we've got Jacob Courtwright on here, who is our marketing associate. And then we have four banking professionals. We put together a panel of these banking representatives from some of Wayland's banking partners. Each panel participant represents a special segment of their respective banking institution. At the end of, we're going to let I'm going to ask questions of each panel participant. And as you have questions, you can pose your questions to the chat room, and towards the end of the presentation, the panel participants will address your questions. So I'm going to quickly introduce just a quick introduction, and then I'm going to let each of the participants tell a little bit about themselves and their financial institution. So number one, we have Drew Shunnison, of the Vice President of Commercial Real Estate at FC Bank. We've got Andrew Glenn, Senior Vice President, Commercial Banking at Fifth Third. We have Steve Kaser, Senior Vice President of Business Banking at Huntington Bank, and Russ Barney, Senior Vice President of Business Banking at Huntington National Bank. So gentlemen, you want to get started? Drew, can you tell a little bit about yourself?
Sure. Thank you to Richard, Jacob, and the Wayland team for putting this together. As Richard said, I'm Drew Shunnison. I've been in banking for 10 years, with the last 4 here at FC. I spent my first 2 years at FC as a C&I lender, and I've spent the last 2 in commercial real estate. For those of you who don't know, FC Bank is a community bank headquartered here in Worthington. FC is one of 4 divisions of C&B Bank. And this distinction is important because it puts us in a unique position in the market. We're able to offer the speed and service of a local bank, but we also are able to provide the offerings of a much larger institution. We can provide a full suite of retail, commercial, treasury, and wealth services. And currently, the bank has over $5 billion in assets, and our Fed lending limit is over $40 million. I look forward to speaking with you all today. Thank you.
Thank you, Drew. Andrew?
Thanks, Richard. Again, Andrew Glenn, Fifth Third Bank. I have been with the organization for 18 plus years now, and it's encompassed a couple of different areas of the bank, starting off in retail through grad school, but the last 14 or so here in Columbus, Ohio, where I've worked 3.5 in commercial credit, and then the last, we'll say 12.5, 13 years on the relationship side in the commercial bank. And the great part about the commercial bank here is it's one of the few areas that gets to touch all areas of the banking, and that we get to work with you, everybody, on the credits, working capital, term loans, owner-occupied property, acquisition financing, but also treasury management, wealth, and also our capital markets division, which has a great investment bank that focuses in on both the asset or the acquisition and sell side of M&A, and also the financial risk markets, which encompasses interest rate, commodities, and foreign exchange. Great 18 years here at the bank. One of the things that I love the most, obviously, is the culture. And it's because of things we're doing in the community, like the recently announced $20 million investment we have in the East Side neighborhood, where we're going to assist with food insecurity, affordable housing, small business lending. It's our ESG focus, which has been a great part of our solar energy. Now the bank is actually carbon neutral as of 2020. And one of the things that I always like to share that people don't really know about is we are a list maker for the third time of the world's most ethical companies. And we're one of the only 5 banks in the entire world to be on that. It's the culture, it's the people, it's the clients that really just engage and been great so much over the last 18 years.
Thank you, Andrew. That was very nice. Okay, now from our Huntington National Bank team, we've got Steve Kaser and Russ Barney. Steve, you want to say a little something?
Sure. Russ is going to do the Huntington commercial, but my name is Steve Kaser. I'm a business banking market manager here in Central Ohio. I've been with Huntington for 24 years, 21 of those specializing in the business banking segment. So my main area of focus is generally on what we would consider 25 million and under in annual sales revenue size companies, helping them for loans, deposits, treasury, any way they need to access the bank. My team of bankers can help, whether that be business, personal, or any other piece of business that Huntington is involved in. They kind of act as that quarterback and their access to the bank. But I'll kick it over to Russ for his intro and the little Huntington commercial.
Thanks, Richard and Jacob, for this opportunity to get together in front of these guys and have an opportunity to share what we do for a living. I have been a banker for almost 40 years, and I've worked in this space for almost 40 years, but I've only been at Huntington for the last 4 years. I enjoy this space. I've learned a lot in this space, and I joined Huntington because of the values, not because of its size or the thousands of branches that they have, but I joined because of the values that they professed when they reached out to me. We try to demonstrate every day our can-do attitude. In other words, when we look at a deal, it's not what are the component parts that disqualify this relationship or this deal or this loan. We try and have a service heart. We look out to serving our communities, and we do that through tons of volunteer work and working on not-for-profit boards, and are involved in the communities that we serve across the state. And the final one is we're forward thinking. We invest tens of millions of dollars every year to have a best-in-class products and services, and to improve the portals where our clients and customers and partners can access those services. And we like Andrew says, we have a full array of the products that you would expect from a pretty good sized regional bank to be able to provide the lending and services that are necessary to businesses in the Columbus market. I work in Columbus, but I also oversee our Cincinnati operations as well. And so I get some perspective from that, but home base for Huntington is Columbus, and that's where our focus is, and that's where our density is, and that's where we try and do our very best in taking care of clients and businesses. Great to be here. Anxious to have some discussions with you and answer your questions and be able to provide some strategic insights into where we might be going forward. So with that, I'll turn it back to you, Richard.
Well, Steve, Russ, thank you. Andrew, Drew, thank you guys. As the participants who are attending today, you can see there's a lot of experience on this panel. So please pose whatever questions you have. We put a lot of time and energy and planning for this with the topics that we thought that would be both timely and of interest to you. So I'm going to get this started. And obviously the first topic is on top of everybody's mind. We know the answer of where the interest rates are going, but let's dive a little bit deeper. So we're going to talk about interest rates, and Andrew Glenn's going to kick us off. Andrew, what would you like to provide to the attendees here in regards to interest rates and whether they're going to go down tomorrow or not?
I don't think that's going to happen, but no, I think we talked about this a little bit yesterday, and I think the big joke about this is if we all had that crystal ball, we'd all be retired right now, just because it's such a story and narrative where it just changes so quickly, and so many macro events, so many events that are just happening on a daily basis, and the volatility we're seeing. We started this year, and our derivative specialists were predicting somewhere between 2 and 3 interest rate hikes in 2022, and another 2 to 3 rate hikes in 2023. I did talk to them yesterday. It is now expected to have 9 interest rate hikes in 2022. It is a combination of many things, but the next meeting for the Fed is actually May 4th. And there's an interesting statistic on that, is that there is a 200% probability of a rate hike by the Fed at that time. Well, you're going to say, hey, Andrew, how do I have a 200% rate hike? That's impossible. What that is actually telling you is that there's going to be a 100% probability of a 50 basis point rate hike on May 4th. The thing behind that is when the Fed meets again in June, there is a high probability there of another 50 basis points at that time. So what that would essentially do, if that all goes through, is put us back to about a 1.5% Fed funds rate. That gets us back to where we were in March of 2020, right before the pandemic hit, right before the Fed dropped things 150 basis points to go to zero. Again, this dynamic and conversation is completely different than just 3 months ago because, we're learning that inflation is at its highest level since the 1980s, early 1980s. The supply chain issues were not transitory like the Fed was originally predicting. The war in Ukraine, commodities, food, housing, all through the roof on that. Another interesting fact here is this is causing extreme volatility daily. So in the past 2 or 3 months, we have seen a 2.5% times increase in the volatility of the daily rates. What does that mean? That means rates are moving at 10 to 15 basis points a day. That is some of the highest volatility we've ever seen in the history of lending and the rate environment. But it's also key to focus in on what happens if we do raise these rates and if they happen too much too fast. Could it constrain the economy? Could it cause the economy to go into recession or somewhat of a downturn? One interesting fact is that if you do look at the yield curve for the next 10 years, after year 3 today, the yield curve is actually showing a little bit of an inversion. So what that is telling us is that really the 3-year and the 10-year are kind of the same amount and the same rate. So there's really no predictability behind that at all, which is quite unique and really making it difficult for the Fed to plan out farther than that. Now, this is also affecting us on the personal side. So we've seen 10-year treasuries go from sub 1 beginning of the year to yesterday at 2.87%. Well, what does that mean for us personally is the fact that the 30-year mortgage that you're seeing now has gone from the high 2s up to 5.27% on a national average for a 30-year fixed. I'm assuming everybody can tell that that's probably just dried up the refi market really quick, and really going to have a hamper on the housing market potentially going forward. So the big focus we're having, obviously, is the conversations with clients on, if we're in a rising rate environment, what do we do and how do we protect the balance sheet and protect the income statement? And the question is, do we fix? Do we remain floating? How do we look at the yield curve and incorporate that in? Those are conversations that any client needs to be having with their banker at this time. Is there an option to go out there and fix? Yes, there's many ways to do that. You can go out and do a natural fixed rate loan, but make sure you understand the prepayments, et cetera, because there could be an MPV calculation. There could be a percentage of the loan calculation each year. There's also ways to synthetically fix the rate, maybe via a swap. That is one that's maybe had a bad taste in the market over the past few years because of the ups and downs we've experienced. But it's one where if you're going to have that conversation, make sure you understand the mechanics of it. It is a very complicated tool, but for the right reasons can be a fantastic tool for a company in that it allows them to budget, have the right pricing, the known pricing, the right cost of funds. It allows them to help manage margin control. And an interesting fact is it's also transferable to other debt going forward. The last thing I want to mention on the interest rate environment is the big change from LIBOR to SOFR. So a few years back, the market made a decision that we were going to cease LIBOR completely as of 6/30/2023. Just numerous issues with the LIBOR market. It was a manipulated rate. It was a bank-to-bank rate. It was unsecured. So what they have done over 2019 and 2020 is kind of defaulted to the new rate being what is called the SOFR. It is the secured overnight funding rate. This is a secured rate. It is based on transactions happening in the market, and it is also backed by U.S. securities. So with that, you're seeing many loans convert from, say, 30-day LIBOR to the new SOFR. And just like LIBOR, SOFR has many options. You have the daily SOFR, and then you have also what's called term SOFR, which you can have 1 month, 3 month, 6 month, etc. To give everybody an idea, 30-day LIBOR today sits at 0.63%, and 1 month term SOFR sits at 0.58. So there is a little bit of a differential. And if you go back over time, it's about a 12% or 12 basis point differential over the last 5 years. So if you are going through any of those changes with your bank, you may see a slight change in spread because of that, anywhere from 10 to 15 basis points to accommodate for that. I know here, us at Fifth Third, as of 9/30 last year, we have ceased doing all new loans in LIBOR. Everything is now 1 month SOFR or daily SOFR. And over the course of 2022, we are converting all existing loans from LIBOR to SOFR. So, Richard, that's quite a bit of information. I'll transfer it back to you.
Are there any loans being out there being made based upon just plain prime anymore? Prime rate?
Not in my world. Everything is LIBOR or SOFR based, but I would turn it over to the rest of the group to see.
In the business banking space, so that 25 million and under, all of our lines of credit are all done LIBOR, or I'm sorry, all done prime based. So if we have a customer that's going to float even a term loan, we would generally base that off of prime as well.
Okay. Thank you, Steve. Andrew, did you have anything you'd like to expand upon from an interest rate standpoint?
Well, I would just say that, just like Andrew stated earlier, we're all aware that rates are going to rise, but how much is definitely up for debate. As mentioned earlier, you start with 3, you move to 9. It's obviously a very fluid situation. I would caution everyone to know that the Feds are kind of trapped right now between correcting inflation and tanking the market as a whole. You add in all those external factors that Andrew mentioned with supply chain, world conflicts, things like that. And I would say the importance for me here, if I were a customer in the market, is I would have a very deep dive conversation with your banker and make sure that you understand truly what your rate sensitivity is moving forward. What does your current portfolio your debt portfolio look like right now? And moving forward, your goals, you reach them, could be very well affected by how these rates are moving. I would also say that you need to be a student of the market if you have any big plans coming up, because the Feds, being in that hard place, they're probably going to try and derive some of their goals in ways outside of hard and fast direct rate hikes. We live in the age of information, and the Feds have used this to their advantage in the past, and I expect them to continue to try and move the market some ways without having to make those hard changes simply by appearances, by statements that you may hear from representatives. And I would say the only way to really know the truth is to plan for the best, prepare for the worst, and to fully understand where you sit now and where you'll have to be moving forward. So that conversation with your banker is huge, especially with each bank kind of handling the volatility a little bit differently. It would, I would say, behoove everyone to really take that time to understand where they're at.
Thank you, Drew. Let me put just a very quick spin, a 180 on this. And let me ask anybody of the panel team here. So from the flip side of it, from the investment side, I'm not suggesting people just convert to cash, but people are converting. So what does all this change in interest rates mean for an interest rate return on a savings, money market, et cetera? So from a non-blending, but from more of an investment side. Anybody?
I'm no retail expert, but I'm probably the closest person to retail, but just getting some feedback there. But, I think we will start to, as rates increase, you will see banks start to increase savings, money market, CD rates. They generally aren't timed exactly at the same time. So banks have a tendency to drag a little bit as rates go up. And tend to be quick adopters when rates go down. But certainly as rates go up, you will see savings and money market rates start to increase as well.
All right, so some time to follow. We will start seeing that starting to follow also. Okay, so Drew, let me go to our next area, structuring deals and refinancing. Drew, we're going to start with you. What would you like to say about?
Absolutely. So with this unique rate environment, folks may be asked to get a little bit more creative with how their loans are structured moving forward. You know, there are some things that the bank may ask for to protect themselves from rate risk, and there are some things that customers may find is unique to this particular loan that they're pursuing that necessarily hasn't been there in the past. Some things to be aware of and some loan structure changes. Many banks, especially smaller banks who have maybe a little bit more risk in their portfolio, they're moving away from the long-term fixed rate products. So, you know, you're looking for a 10-year fixed rate on a 30-year amortization loan. You know, that's going to be difficult for a lot of banks to accomplish simply because we don't know where rates are going to move and for how long they're going to move. Floating rates are becoming much more popular options for banks to offer. Some of the reason being is that customers are a little bit in sticker shock when they're starting to see some of the fixed rate quotes that they're receiving on their term sheets. And by floating, you know, with not knowing the future and not having that crystal ball, floating may actually be a cheaper option for the foreseeable future. And you can maybe buy yourself some time by floating and staying at that lower rate closer to that index as a whole. And when things start to move or you start to get a better picture of what the future may hold, you know, you can always take another dive or another bite at the apple, so to speak, with getting that fixed to where you want it to be. I'm also seeing some unique terms and with regards to like non-construction commercial real estate loans. In the past, you know, if you were just refinancing or making a traditional purchase, you'd have a fixed rate portion to start with. And now some folks are moving to interest only or floating initial rates for the first few years of their loan, simply to let things settle, followed by a mini perm or a fixed portion on the tail end. And while that is not unique to say like a construction loan, it is definitely unique to a more traditional purchase. But what's happening is by structuring it that way, folks are, like I said, buying time, but also enjoying the lowest rate possible at this time. Riskier construction loans may now come with an equity burn down as opposed to a loan to cost upfront funding. So banks may ask you to contribute all of the equity into the construction upfront. And then as things are improving in the property and as the property is getting leased up, that money can come back to you. Sometimes they'll even have a higher rate initially. And then as you get leased up or as the property starts to perform, you'll actually see a rate burn down where that rate will decrease. I'm also seeing that on variable rate products, floors are being instituted more often and caps are being removed. So before, when you went with a variable rate, you used to be able to kind of set the parameters of where your loan would fall into. And I think the doors are coming off of that simply because no one knows what the future truly holds. And so that rate volatility sometimes will transfer back to the customer simply based on how the market is moving right now. So I would say if you're talking with your banker and you hear something that seems out of the ordinary for where you've been in the past or how you've done things in the past, it's simply a product of the market. But I would say that there are definitely strategies and advantages to simply understanding kind of why the bank is offering what they're offering you. And then also make sure that you negotiate. If that floating rate, variable rate product is not what you're looking for, talk to the bank about what will it take to get that fixed rate done? Where will that fixed rate be? How can I protect myself? I think it all comes back to that communication moving forward.
Thank you, Drew. Question, are floating and variable just merely interchangeable terms? Is there any difference?
They can be. Yeah.
All right. Steve, would you like to, you have some?
The perspective in my space, 25 million and under space is a little bit different. Whether that be through sophistication of the borrower or the dollars that generally we are working with have a tendency to be smaller than maybe what Drew is working with in his world. We're still facilitating up to 10-year fixed rates. Obviously, with rates moving as quickly as they have, I mean, literally 20, 30 basis points sometimes a day. We can't commit to anything. In the past, we would, say, hey, this rate's good for 30 days. Those days are gone right now. So, our clients do bear the risk of what happens between now and closing. But we still are facilitating a lot of fixed rate debt, even up to 10 years on real estate. for our client base, a lot of them just want to know, what is my payment? They don't have these in-depth financing departments and stuff that are tracking rates and can monitor their overall rate tolerance. Most of our clients are wearing 10 hats as the owner. So they're the CFO, they're the ditch digger, they're everything. And so a lot of those folks just want to know what their rate are, or what their rate and payment are. So, we continue to facilitate that. We are having a lot of floating rate conversations in a raising rate environment. That is certainly a conversation we have, and we are seeing customers select that option because, inevitably, a lot of times people aren't going to be in their building for 10 years. It's different than a home. So, but that is still something that we are seeing in the business banking space. So I would be prepared to have that conversation because it's an important one, and you need to know what your risk tolerance overall for your company is, so you can decide what is the best option for you.
Thank you, Steve. Thank you, Drew. Okay, our next topic. This is one of our most important topics aside from our borrowing, structuring, and interest rates. Let's talk a little bit about relationship management. Russ?
Well, when you're in a service industry like CPAs and banks are, the relationship is the key to what you do. You have certain products that you hold on to and you distribute and work with your clients with, but the relationship is the underpinnings of all of that. And we all recognize probably that a trusted relationship with a financial professional, or whether that's a CPA or whether that's a banker, is critical. I think that trust can be based on things that are easy to see. I would refer back to the definition of trust in The Speed of Trust. That book is a good book. It's about 12, 15 years old now, but in that book, it talks about your character and your competency is what is combined together. Those are the component parts of trust and building trust. And so when you're looking for a banker or a bank or a customer that you can trust, or a CPA that you can work with full confidence, you're looking for somebody who's competent, who knows and understands their business, who knows and understands your business, and is interested in diving in and learning your business, and so that they can provide some advice that is meaningful to you, and it's not just textbook and it's not just platitudes. So I think that is the basis for a relationship. And I would also caution that I think it's important to develop a relationship from the point of a banker. I don't think it's very healthy for customers to develop a relationship with a banker and not the overall organization. The organization provides a ton of information. Financial services is very complex, as our CPA friends will tell you. That there are changes in the law every year, sometimes even more frequently than that, depending on which group is looking at the gap principles and that kind of stuff. It changes all the time. And so to expect one person to be able to stay on top of every facet of the financial markets that are so complex and so volatile and moving is pretty tough. So I would encourage you to develop a team approach like with Wayland. So you can go in there and they can help you with 2 or 3 different needs, because they have people that specialize in those different needs that are maybe more appropriate to your type of business or the industry or the NAICS code that you operate in. That's the same thing with a bank. A bank brings with it a multitude of products, and to be a specialist in that, it is really tough. If you're trying to be a specialist in everything, you end up being a generalist, and I'm not sure you can bring the most up-to-date, quick moving expertise that might be necessary for a specific instance in your business. So I think that's important to remember. I think we all have in this group here, I'm sure we have specialists within our financial organizations that we bring with us. I know at Huntington, that's what we do. We rarely come and call on a client or meet with a client without having at least one other partner that is tailored to the instance, to the loan request, to the relationship, or something like that, so that they can provide some very specific and very detailed and very accurate information, which helps us develop the competency in working with our clients. And it may be different in this week's meeting than it will be next week's meeting as we learn more about the business and the situation and what we're trying to solve for. We may bring different professionals or partners or specialists with us to help us with those conversations, so we bring the best stuff, the best goods, and that kind of stuff. And I suspect Wayland does the same thing. I doubt that they have a superstar that knows everything about everything. You probably have to specialize a little bit and bring those people to the table when you have instances arise. So I think relationship management is important. it should be managed from both sides of the equation. The end user, or in other words, our clients, need to be working on relationships and building those with the banker, and the bank needs to be doing the same thing, or the CPA firm needs to be doing the same thing back. Now, to have a trusted relationship with anybody, it has to be open, it has to be non-threatening, it has to be transparent in so many parts. Unless you're comfortable putting the information out there, you probably don't get the best solutions. If you go in with a problem with your car and you say it makes a funny noise and that's the best you can do for describing it, they might spend a whole lot of hours trying to figure out what the problem really is. But if you can come in and be open and transparent and say, well, I ran over a rake and, I pulled a line underneath the car, just fess up. If you got a problem, let's solve it together, and it takes less time, energy, and effort, and you'll get a better solution. So that's what I would say. Sometimes we face clients that are maybe confused, maybe a little bit embarrassed at their lack of knowledge, and that should not come into it at all. That's not what we do as bankers or as CPAs. We come in and looking for a way to diagnose the problem and help you fix the problem, whether that's an expansion of your business or a new facility that you need or updating your equipment, whatever that might be. We need to come in and be open and honest with each other. We'll do the very best we can on our side to give you all the options and help you choose what best fits your situation. I think probably looking at the 3 banks that are represented here, there's not a product pusher among us. There are banks that do product push, but that's not the way any of our 3 organizations work. So you can be open and honest, and we will give open and honest help back. And hopefully we can develop those relationships of trust so that when something comes up, we can solve them quickly and get to the right answer and not have any misdirection and starts down one path and turn to another path. And interest rates, it's important to talk about that. And that was brought up by the 2 presenters on interest rates. We need to understand fully what your needs are. If it might be, I just need to know how much out-of-pocket cash I have to spend every month, then that's the way we can frame our solutions to it. If you're interested in interest rates and you maybe want to pinch the margin down and play the markets a little bit with a floating rate, that's okay too. But just know full well that when we go to underwrite that, we're going to look at how a rate in a rising rate environment, we're going to hedge it up a little bit to see when rates go up 2%, let's say, we need to know, can you make your payments if it goes up 2%? How does that impact your income statement, your cash flow, your balance sheet, and your whole business model, so that we can make sure that we don't put you in a situation where you fail. We never go in that, and I know the 3 banks we work with, there's not a one of us that starts down a path with the intention of trapping anybody or getting them in a position that's untenable. We do everything we can to make sure that the decisions are good and the information that's used to make the decision is good. And that all comes back to trust and being able to be open and honest with each other and really searching for the best solution. Everybody wants a mechanic that's a good, fair deal. I don't want the mechanic that's about to go broke because he doesn't charge enough, but I don't want him to earn their Christmas bonus on me when I bring my car in for an oil change either. So I think we just have to make sure that we're open, honest, and trusting with each other and do everything we can to develop those relationships. And I think that's the basis of what we all do, whether we're CPAs or whether we're mechanic shops or whether we're painters or whether we're bankers. And it's being trusted and have a reputation of being good at our word and doing the right thing. It's why I think our the values that we portray, we try to live up to, is doing the right thing for our client and doing the best we can every time. So with that, I'll turn that back to you, Richard.
Russ, that was perfect. I appreciate you bringing up transparency. And we work with all 3 of your financial institutions and each of the 4 of you individually. And I know that you really get to know your clients and your customers, and that's very, very important. Let me mention, I've seen this many times. Tell me what you'd like to say about this, is that I see our clients when they're doing extremely well. They're very eager to speak with their bank and to share the positive results. When they're having a potentially struggling year, they're very hesitant. Now, we push the clients, we say it's more important than ever to reach out and speak with your banking representative so that you can work through this together, because they're going to find out about it sooner or later anyways. It's better to work together. Russ, what can you say about that?
Well, 2 things. Number one, we are, because we expect a lot of those that we work with, we expect even more of ourselves. And so sometimes if we find ourselves in a situation where we're confused, unsure, maybe even a little bit embarrassed about Q1's results. We tend to hold that tight to our chest, and I agree with 100%, Richard. The best thing to do is to get it on the table early so you have the most options for solutions. We've all taken a computer programming classes where you work with a decision tree, and the farther you are down the tree, the fewer options you have. And that's kind of the way that it works when we're solving for problems and needs in a business. The earlier we get brought into the conversation, the more options generally are available. If you wait till, you know, your AP is climbing your frame about getting paid and they're filing liens and that kind of stuff, you don't have very many options when you go to your other financing partners and ask for help. So the earlier we find out about that, better the solutions come, the more timely they are. And well, we're not as judgmental as business owners are. We don't sit around and go, oh, did you see that one? We just don't do that. We go in there with an attitude to fix it and help it be successful. Nobody wants to go to work and fail, and we take that on as a personal challenge. We're there to help people succeed and to do well. So I think all three of the banks share that perspective, and these are early is better, totally transparent. We're not going to judge you. We're not going to make fun of you or make your life hard. We're going to do our very best to help you succeed.
Thank you, Russ. I think there's an underlying message here for everybody, and that is that, you know, the banker or the banking institution of yesterday, where it was all just about lending, and that was the extent of the knowledge, lending and where to put your money. You gentlemen and the others in the banking community are advisors. You're advisors to your clients and your customers, and the rest of us need to know that and understand that. You have a lot to offer. So Russ, if you would lead us into our next topic, which is cash flow, which pertains to cash flow and loan covenants. What does all these new happenings in the financial world, what does that have, what impact does that have on loan covenants?
Well, cash flow, I would say, is the blood flow of the blood source of everybody's business. That's why you do what you do, is for the cash flow that the engine of your business puts out. And every engine is a little different. It has component parts, and it's how you take your money in, what you do with that, and purchasing new inventory, creating new products to sell, how you sell them, how you collect that money back and put it back into the cycle to start the cycle all over again. And so we get very involved in that cash flow cycle as we look for solutions. And I'm not just talking, like Richard said, I'm not just talking about loan solutions. We're talking about ways to aggregate your liquidity so you can get a little bit better return on it, ways to be more efficient in the way that your payments come from your clients. So there's not mail time, there's not float time that you're paying interest on that they're not. There's just so many components in a cash flow cycle. This is where we might be even more granular in our questions to businesses than we are even in the credit pieces that we work on. We're pretty thorough and been practiced at that for a lot of decades, doing that with credit, but with the treasury management products, it's where we really can make some advantages. For example, if you know, and I think all three banks probably offer a corporate card. If you have a corporate card, that's a way that you spend your money with your suppliers, the ones that will take that. You basically pick up about 45 to 55 days of free liquidity, working capital, with that card as it floats at the bank, rather than you having to put the money out day one and take it off of a line that's going to charge you interest on day one. So that's just one example of ways that we can fine tune and look at things. Every now and then we run into somebody and we say, how do you receive your payments? They say, well, I don't want all those checks coming in at work because those checks can get stolen. So I have them sent to my home. And so, you know, it just slows things down. So your money's not coming in. There's so many better ways through merchant services as well as ACH and wires to move that money quickly. And with less risk. And we'll talk more about risk down the road with some fraud discussion. But I think it's important to understand your cash flow, and it's important for your banker to understand your cash flow. And they're not being prying and they're not being snoopy when they come in and ask a question like that. How do you get your payments from your clients? Where do you receive them? Do they go to a lockbox? Do they come to your house? Do they come to your business? Who has access to those before they're opened up and posted to your account? How do you post them to your account? Do you have a remote deposit capture, or do you have to send Betty Lou down to the branch once a day, and so she goes down and gets a dum-dum sucker from her favorite teller, and she's gone for a couple of hours away from work? There's just so many efficient ways nowadays to do that, and that COVID has done us a favor in that regard, because it's forced us to do things that we didn't have to do before. We're also going to talk about staffing in a bit, and those kinds of products and services, especially on the treasury management or the deposit side of the equation, can create efficiencies that we've experienced and learned about that help with your staffing struggles and filling positions, because we can automate so much with integrated payables and tools like that. So the cash flow is important. Cash flow pays back loans. Cash flow makes your payroll. Cash flow helps you buy new inventory. It's just absolutely critical. Liquidity is good. I'm a little concerned right now because I've ran across a couple in the last 2 weeks. I worked on 2 credit files where people see great opportunity in the market to go out and expand their business by acquiring one of their competitors or another business similar to theirs or even smaller than theirs. And they pull it on because they've had these cash balances sitting in their account for a while. And we have one that we're working with right now. And now they went out and did that. And now they're coming back and saying, ooh, we miscalculated by increasing our sales by 80%. We need more working capital. We got to have a loan. We got to have a loan quick because our operating liquidity needs just went up big. And so now we need some permanent working capital and liquidity in order to support the new level of sales. So we try to work with you in those processes to make sure that we don't get to that point, that we think about it beforehand. And so we come up with a sustainable growth rate and a sustainability in what you're trying to do. And that has to do with so many parts of your cash cycle that we dive deep into those and try and help you understand that. You may perceive it as us pushing back on a great deal and a great acquisition. In reality, we're trying to make sure that neither one of us fails. We want to have everybody be successful, and so we want to make sure we're in a good position on those kinds of expansions. But we do that after we decide that something's a good thing. We do throw some covenants on there from time to time. I would say that probably our most frequently used and maybe most important is fixed charge coverage, where we look at new debt that you've brought on with an acquisition or a purchase of a piece of equipment. And we want to make sure that your cash flow is sufficient to cover it with a little bit of margin for all the bumps and hurdles and things that may come down the road with your business. So I would say that's the one in our business that Steve and I operate in the gross revenues from about 2 million to 25 million. That's the one we probably rely on the most. There are other ratios and things we work with, but as far as a covenant on a loan, fixed charge coverage is a big one. Steve, am I missing anything that we see more frequently than that?
Sorry, I couldn't find the mute button. I had to be the first victim of the mute button today. So, we also utilize net worth quite a bit. We see that one in our space, maintaining certain level of money or net worth within the company. In the business banking space, a lot of times the business and the personal is somewhat interchangeable at the owner level. And so as the dollars that we lend go up, we want to see more of that held within the company. So it's a pretty common one as well.
This is for Russ or Steve or any of you. Is there a certain point and the dollar amount of the amount being lended, at which point we commonly start to see the financial covenants start to kick in?
Yeah, generally speaking, you wouldn't see a covenant on anything under $500,000 at Huntington. And generally speaking, it doesn't really kick in until you're over $1 million. There are some instances, if there's concentration with a supplier or a customer or something where you may see something under $1 million, or you may see a debt service covenant or something along those lines in some of those smaller loans. But again, anything under $500,000, you shouldn't or won't see it most of the time. And then in that $500,000 to $1 million range, you will see it occasionally. And then it gets pretty common over $1 million.
Thank you. And then some of the non-financial covenants that are fairly standard in some loan agreements, but submitting financial statements and a few other things.
Correct. Yeah, and that's pretty common, especially anything with a line over $500,000, or I guess really over $1 million on lines. Most of our lines today are done on demand versus stated maturity, $1 million and under, so that you don't have to send those annual financials. We'll do some analytics on the back end to make sure we think everything still feels good from a scoring perspective, so that we're not touching it as often, which is beneficial not only to us, but to the client by not having to submit financials. So.
As the deal grows and gets more complex, though, then we have sometimes the quarterly and annual reporting requirements that come in that our CPA friends get involved in sometimes with us too.
Yeah, that's a great point, especially in the area I focused in on. We see a minimum quarterly financial reporting on every company and relationship. Again, I focus in on 40 million up to publicly traded in revenue size. Quarterly financially is a minimum. Most, I'd say 90% of all working capital lines have some borrowing base calculation tied to that. Just for general terms, you're going to stick to the normal 80% of receivables, 50% of inventory, with an inventory cap somewhere probably around the 50% mark of the line amount. As for, again, covenants, fixed charge, 90% of all transactions are going to see some form of fixed charge covenant, just to make sure that all those charges can be covered pre and post close. Also was that little buffer that Russ talked about. The other big one we see is the cash flow leverage, and the cash flow leverage, because it incorporates both the income statement and balance sheet. And as all of us being the senior best source of financing, you're going to see a little bit lower tiers in that aspect. Definitely want to keep it under the 3 times. Start getting above 4 times. That's where you start getting into the mezzanine worlds, et cetera, secondary lending markets, maybe even higher in angel equity, et cetera. But really, that 3 times or less is where you're going to see that covenant come into play, more or less on anything. And they're all done on a trailing 12-month basis. Just so we had that calculation, so it takes out any seasonality, et cetera, for the client.
Okay, well, we obviously have, I'm not certain of the clients who are participating today, but we have a lot of clients who have lending vehicles with each of you. And I'm going back to the transparency and how important it is, because there are times where these covenants are in place and you can start to see ahead of time that they may be out of covenant, we may be out on one of these covenants. And that's where it's important, again, to have that relationship and speak with your banking advisor sooner rather than later, because the bank will commonly issue a waiver, right? It's not a lot of us and a lot of the clients who have these loans think that all of a sudden, if we're not going to be in compliance with a covenant, then it's the end of the world. Well, it's not the end of the world. Again, it's an issue that has to be tackled, but it's an issue that has to be tackled by the 2 parties. So to start talking about it sooner rather than later, it puts the bank in a better position to help the person who has borrowed the funds to be in a better position.
That's a great
Absolutely.
point, Richard. I mean, the covenants are there to bring the parties together to talk if there is an issue. Is anyone really ever seen anybody, a bank, kick a client out because they defaulted on a covenant? I mean, I've been 18 years, I still have yet to see that. It's meant to drive conversation, meant to drive the dialogue to the understanding of what's happening and how we progress forward and how we plan for that going forward. I had that conversation with one client this week where they were pressing up on a leverage covenant. And we've been talking about it actually since the beginning of the year, knowing what was going to happen in the first quarter. And so now we're able to plan going forward a new covenant structure of what is best for them as they absorbed in that acquisition, et cetera. It really comes down to what Russ was talking about earlier. It's there for the constant communication. And that's what the relationship is all based on. We want that transparency. We want it both ways. We want to be transparent with you. We want you to be transparent with us, because let's face it, we each have a lot of money invested in each other. We have millions of dollars invested in you. You have millions of dollars invested in us in deposits. It's a 2-way street. So that's where that dialogue and that constant communication is more important than ever. And one point I want to make earlier, like the term commercial lender, I think this isn't 1980s anymore. Richard, you said it right. It's a commercial bank advisor. It's a bank advisor at this point, because lending is only a piece of everything we're talking about today. It's everything else. It's the credit. And like Russ talked about, the cash flow is even more talked about today than lending is 90% of the time. So it's a very different dialogue today than it was even 10, 15 years ago.
Yeah, very, very important. And I would say that, again, for the participants and maybe some people on this, on our webinar today, that we have attended client meetings with each and every one of you, whether it has been a lending situation or a succession planning meeting, ESOP, those considering ESOPs, et cetera. So my point there is that you can see there that these meetings and this service, it goes well beyond just a borrowing or investing capacity. It goes well beyond. And again, further proof that it leads to a team of advisors. It's not just you from the banking perspective or us as the CPAs. It takes a team nowadays. Things are complex. So it's hard for any one institution, any one representative to meet all of those needs. Okay, so that all leads us into another very, very, very important and timely topic. And that is what, Rush, you led us into this and mentioned this: treasury management, staffing issues, technology, cyber insurance, fraud. They're kind of all in some capacity under one umbrella. But Drew, if you could get us started on that, we would appreciate it.
Sure. So many of you on the phone or on the line have probably heard your bank mention the word treasury management. And while that is a broad term, when you boil it down, treasury management is the technology that is involved in the movement of money for your business. So whether that's you taking in money, you sending money out, you retaining that money, investing that money, whatever it may be, treasury management are is the technology or the tools that you can use to make that happen. So some examples that I'll give you: wire, ACH, positive pay, remote deposit, sweep accounts, lockbox. So really, as you think about how you accept money from your clients, they're probably utilizing a form of treasury management service, and you are probably utilizing that as well on your end. The benefits here are immeasurable, and the reason that as Richard was alluding to, the reason that there are so many kind of topics rolled into this is because how you move your money is that cash flow, that lifeblood that we've been talking about. And so, the number one type of fraud is still check fraud. So while checks are moving away, they are still the number one way in which folks can take advantage of your business, whether they're getting into the mail and taking out a check, whether they're printing a check themselves. Those things are still happening at an alarming rate. And so the best way to prevent that, of course, would be to send the payments directly electronically to the places they need to be. And so having the ability to have a secure token to where you can go and send your wires, and then having that wire be reviewed by someone at your bank team, that's huge. ACH also an easy way to collect payments from your customers and to issue payments to your vendors. That just eliminates the need for that paper check and for that third hand, right, to be involved in your transaction. Along those lines and along the lines of fraud and protection, positive pay is a great tool for those who can't get away from writing checks. Positive pay allows you to set up a ledger of allowable check transactions to be run. And if one doesn't meet that criteria, it gets flagged and you get an opportunity to review it before those funds are moved. And so this is just another layer between you and the potential for something bad to happen. Your remote deposit, maybe you're taking in checks and you're worried about that process. Well, instead of sending, was it Betty Lou, Russ, was your example? Instead of sending Betty Lou to the bank to cash those checks, being able to scan them in right at your desktop, ensure that the information is accurate, be able to retain the copies of those checks for your records. It's huge. And then, while not as popular as they used to be, a lot of folks still utilize sweep accounts with regards to their lines of credit. It's a great way to ensure that the money is being moved out of a potentially exposed account to an account that's deemed more secure because it doesn't have check writing capabilities or the like. These tools, while preventing fraud, also can help with things like staffing issues. So maybe you're light on personnel. The pandemic has kind of taken some of your folks away, whether it be movement, retirement, whatever that may be. Well, having these treasury management services in place allows you to do more of the work more efficiently on your own or with more limited personnel. If you don't need to send someone to the bank to run your deposits, you're eliminating, that one job. Well, all of these different services can help streamline that and make it easier for one person or a small group of people to take on the tasks that maybe required additional personnel on the floor. And so really, I would say you probably will hear the buzzword treasury management. Just know what that is. And if you can think of maybe a pain point that you have or the stuff that keeps you up at night regarding how you're moving your money in and out of your business, your bank, most banks can offer that full suite of treasury services and really kind of streamline that.
Yeah, that's one recommendation here is to make sure that you're talking to your banker and have an annual treasury management review. The reason that is so much more important today than ever is because this is an area of the bank where banks are spending more money than ever. I mean, as Russ said earlier, we're spending hundreds of millions of dollars annually with fintechs and technology companies to find ways to improve treasury management and treasury management solutions. And it's really coming to be more of a tech business than anything these days. Like Drew said, sending a check is really kind of almost an antiquated way to move the money today. It's also the most unsecured and riskiest. So there's better ways to do that. And that's why banks are spending hundreds of millions of dollars to do this annually, to improve these services, to protect your money, to keep it in your account longer, to pay it out slower, et cetera. With the automation and the way things are going today, it also helps with, like you said, putting people in the right jobs, not just doing services of running to the bank or running to somewhere else to get something they need. It is so much more efficient today because of that. So I do recommend that everybody at least sit down with their bank and have what's called an annual TM review to review that, because there is new stuff and new solutions coming out faster than ever. It is really accelerated in the last 5 years, and it's only going to accelerate even more the next 5, is how much money is being deployed in this area, pretty much more than anywhere else in the banks.
I couldn't agree more, and I'll just add 2 pieces to this. So one thing that a lot of business clients don't maybe understand is, they are responsible for protecting their account and are responsible for the losses if they do not. There are some protections that are put in place on the personal side of the bank that don't transfer to the business side of the bank. And so, the bank is expecting them to monitor their accounts and protect them. And if they don't, there's only so much the bank can do to try to help retrieve those funds, because once they leave us, they're very hard to get back. So we see examples daily, frankly. I don't try to want to scare anybody, but every day we are dealing with fraud. We have fraud happening in a variety of fashions, everything from washing a check to ACH requests, wire requests. You would be surprised at the things that people do. We've had a client that had a customer that they were doing business with. Their business was concluded. They had somebody on their staff go ahead and request payment because they knew Billy Bob or Billy Sue or whoever Russ's example was, and requested that they still pay them. It went on for 6 months before anybody caught it. So, these things happen every day. And that's a direct loss to the business. And so, by putting some of these things in place, the bank can stop that transaction from happening in the first place. And that's really your first line of defense. I tell my clients all the time when we're talking about cyber risk, you own a home, you own a car, you have insurance on it, right? A lot of people don't have insurance to cover this. And so cyber insurance is the other piece to this equation that you should have reviewed immediately. What is your coverage? What are you exposed to, and what kind of coverage do you have to protect your business? So that would be the other piece, that I think is critical component to protecting yourself. So
I couldn't agree more with you, Steve. As those underwriters look to put your insurance policy in place to cover those issues, what they do is they review your internal office accounting practices, and that will make your CPA smile as they look at division of duties and controls and oversight and pins and control of passwords and all that kind of stuff. So I think that's really critical if you're looking at your business and trying to see how to run it as tight as possible. I would also agree with Drew that those annual reviews are something not that you should dread, but that you should look forward to. We were doing a review in Cincinnati in the last 2 weeks, I think it was, and we were with the client and we were going through and talking about they felt it was time for them to start using a Dropbox because they were having a hard time staffing part of their office operation, and they had tremendous amounts of payments coming in through a Dropbox through checks. It was actually a medical practice. So they had lots of check traffic, and as they were reviewing that, it came to light as they discussed the problem that a Dropbox can gather your invoices for payments going out as well. And so they can come into your Dropbox, be segregated from the payments that come in, be digitized and forward back to you. And that takes care of somebody else opening mail and getting your AP processes started because they're all digitized and come to you and they're in a folder, and it simplifies all that stuff and reduces your staffing needs. So those are little nuanced changes happen all the time like that. So you should jump at the chance, like Andrew said, that a review of your whole treasury management. I think that definition needs to be broadened a little bit. I don't know that we call it treasury management. It's almost office management because of the component parts, and the digitizing and the automation that can take place. You can get set up to the point where as payments come in, you can they go right to your general ledger to the right categories. Same thing with AP. It can all be automated so you don't have to have people double posting and second posting and taking care of making it all get there. We work closely with your CPA firm and your CFO and your controller to make sure that those are all meshed right, and we review those every year or quarterly or whatever the need is. But it can automate so much of what you do. It lets you go out and do what you do best, and that might be painting a building or fixing a car or whatever your business is involved with. So I agree with Andrew 100% that those annual reviews are necessary. They should be an exciting time to look at what you're doing, make sure you're doing it the very best you can. And the insurance that Steve mentions is absolutely critical now. It's sad to us when we run across these things like Steve's team had somebody that happened a couple of weeks ago. It's sad for us when our customer gets hit for $20,000 a month for the last 7 months. You know, that's a big hit. That's not loss of inventory that you only have a small cost in. That's bottom line dollars. That's liquidity that could be working capital moving forward to grow and get better. But anyway,
Yeah,
lots of facets.
Just to add to that, because I think Andrew, you brought it up yesterday, and we see the same thing on our side. The crooks, frankly, are targeting the bank less because we're harder to get
Absolutely.
into. And so they are targeting the individual business customer because it is easier. They only have to fool one person, right? And so if they find out who the owner is, who pays the bills, they're calling maybe an hourly employee who thinks that they're talking to the owner via email, and they send a wire because they think they're doing the right thing, right? And so that is a very common occurrence that we see happen. And so, the onus has really shifted to the business owner and making sure you have protections in place to cover that. So,
Yeah, phishing all-time high right now. And Steve said, they're attacking the business owners, the companies, and they're doing those phishing emails. So have that wire protection, do verbal verifications. They're monitoring your email and learning trends and patterns to know when to strike, to send that perfect timing email to say, hey, send this wire to this company, or this account number and routing number changed. Here's the updated information. And it just goes through. I've seen both these here in the last year, unfortunately, where that did happen and a client fell for that phishing scam, and then the accounting number and the routing number changed. It was $400,000 that got sent out of that company. The problem was they didn't realize that for 2 months because they thought their client was paid. No one said anything. Then finally the client came back to them and said, hey, I haven't been paid in 2 months. Where's my money? Like, we paid you. That's when it got discovered. So make sure you have that. And then on the cyber insurance, I can full-heartedly tell you it works. Have it. The ransomware attacks are on the rise as well. It is sad to see, but it is something that we are faced with at this time. And I have seen it firsthand where if it is happened and the ransomware does come through and they hold your company pretty much hostage, that the cyber insurance will come in and assist with that and help solve that situation, either giving the key or unlocking it, whatever. And then also paying up on business lost. So the cyber insurance is an absolute almost must at this time.
And we at Whalen and Company couldn't agree more. Let me ask, so Steve, you brought up the term washing. Drew, you had brought up early on when you started this conversation about treasury management, you brought up positive pay, and they kind of go, I think those two go hand in hand. Can one of you tell the group, but for those who may not know what check washing is, and then can you tell how important, because I think at this point in time in the banking industry and small businesses, maybe even large businesses who aren't doing everything by ACH, that positive pay is a must have. Can you tell
Sure.
a little bit about the two and how that works together?
Sure. So I'll start with what check washing is. So check washing is where folks will take a legitimate check, whether out of the mail, off of a desk, whatever it may be, and they'll use chemical agents. Sometimes it's called check bleaching, but it's not really bleach that they're using. And what they do is fade out either the ink that was used to write the information on the check, or they'll eliminate certain digits from the check in order to make it more plausible, and then they'll transform that check into something that they can use. So maybe you wrote a check to Betty Sue, well, someone washes that check, and now that check's been out to Richard. Richard's going to the bank to cash it. That check is valid in every other way, and it's very difficult to catch. Very easy for people to perpetrate. You can go online right now and Google how to wash a check and probably find that solution in a matter of minutes. And so what positive pay is positive pay is a general ledger that your company maintains with the bank. So some banks will have their own unique platform to fill it out in. Some banks will simply accept an Excel form, but essentially what it does is it lists out who the check was written to, the check number, the dollar amount, the date it was written. And then as the bank goes about their day, you'll get an update of the checks that were presented, and you can approve them at that point in time based on your general ledger, or if you've already forwarded that ledger to the bank has the permission to approve them, but they have to match those criteria exactly. So when I spent my time as a retail banker, I can tell you countless times a check would come in and be presented, and as I was inputting it into the system, there would be a positive pay notification where I would have to go and ensure that the information on the check matched what the bank had received from the customer for what that check would be for. What this does is it creates a pause between when a check is presented and when the check is accepted. And when I say pause, it's not a delay of days or anything like that, but it just adds a buffer of security, because that check cannot be cashed unless it matches the information provided entirely. There's also reverse positive pay, which is where every item is presented to a business owner throughout the day. And so they don't upload a general ledger, but each item that was presented, they review individually and approve on their own. So they'll log into a web portal, they'll be able to approve the checks that were presented, they'll be able to reject the ones that don't necessarily meet what they thought they should be. And it just eliminates the ability for a bad check to go somewhere, or a washed check to go somewhere that it shouldn't. And as Andrew alluded to, the investment that banks are making into treasury services, the positive pay experience has improved year over year over year. It can sound cumbersome, but I would say these days it's so streamlined. You're already inputting that information into your QuickBooks anyway. The form that you're using to submit to the bank is going to look very similar. And so it just adds that buffer, creates that pause, and it can make you feel better about those checks that maybe you're writing, whether it's to employees, to vendors, what have you.
Thank you, Drew. I would suggest that everybody look into positive pay who does not have positive pay, who are writing checks, and each of your institutions offer this. And it is it's almost a negligible cost for the protection of what the bank offers. I can tell you many of my small businesses that have worked with the banks, and I don't want to hold each of you to this, but I'm saying this is like a $35 a month fee. Something it's, maybe a little more, a little less, but it's insignificant for what you receive. And the work that you have to put into it is minor also, because you're already doing the work as your internal accounting departments. So our next area that we'll hit upon, and Andrew, if you'd lead us off into this, is succession planning and capital markets, and maybe even touch just a little bit, since we have everybody here. I've had so many clients and so my colleagues here at Whalen asking about ESOPs. I know that Fifth Third specializes in that. Maybe you could tell us just a little bit, so that people understand a little bit of what an ESOP does and how a bank can contribute.
Yeah. No, thanks, Richard. This is where we spend quite a bit of our time actually as well, in addition to treasury management, is succession planning. Because if you look at the next 10 years going forward, there's some statistics out there that show that 70% of companies are going to transition hands at some point during that time. So how do they transfer? How do they monetize that asset that they built up for their lifetime? So are you prepared for that? And what have you done to prepare for that? I'm sure many clients out there are getting calls on a daily basis or weekly basis from PE firms, strategic buyers, financial buyers. Hey, I'll buy your company for X times. Well, how do you know it's really worth X times? Is it worth more? Or is it actually worth less? So we're actually sitting down with our clients and going through what we call like a strategic alternative analysis, because you don't know when you're going to plan to sell, or you may have it say, I'm going to sell in 5 years, or I want to sell in 6 months. But let's go through the strategic alternative analysis. And what you're going to do is you're going to analyze each of the 8 ways to transition a company, from intergenerational to PE to an ESOP, whatever. And you're going to put that through the valuation test and see where those multiples range out for your company, industry, revenue size. And then you're going to find also your strengths and weaknesses. And it's going to poke holes in if you have a concentration risk, or if you have a management team that is not transferable, or all the relationships reside with the owner. And it's going to go through that and help find that. And this is more important than ever, because what if you are solicited with an offer and saying, hey, I'll give you $30 million for your company? Is that the right value? And I'll give you a recent example. We went through one where the company was solicited with an offer for just $20 million, but they paused, did not go through it. And we went through a strategic alternative analysis with them. And we were able to show that if by doing that, if they were able to just take their EBITDA of $1 million and take it from say $4 to $5 million and get it to that next tier of the market where it needed to be, and correct a few things inside the organization that created value, that you went from a 5-time multiple to a 6-time multiple. Well, you just took the company's value with a short 6 to 8 month time frame from what would have been about $20 million to $30 million. So you just created $10 million or 50% more value for that company by going through these strategic alternative analysis to show you the strengths and weaknesses of what's out there and what's going on in the market. And let's be honest, the market's been absolutely just insane the last 2 years. And it's just because it's like we talked about yesterday, it's been the perfect storm. You've had historically low cost of funds. I mean, almost a zero interest rate market for the banks. Companies are coming through the pandemic much better than anyone ever expected. So they're coming off good years, and you're seeing their EBITDA rise. Well, also because there's the buyers out there are raising the multiples to purchase these companies because the competition's so high. So you're seeing both sides of the equation raised real quick, with the multiples going up and the EBITDAs going up. Then you add in the final factor is there is just a ton of cash and capital sitting out there. PE firms sitting on $2 trillion of overhang. Companies are sitting on strong balance sheets with cash, like Russ mentioned earlier. So what do? And it's just been the perfect storm for that going forward. So it's really important to understand when these opportunities present themselves, where your company sits, and not just going, well, I heard my friend sold for 10 times, I must be worth 10 times. No, now you will have that reference point and understand that, so you have the right value for your company. One of the things we have seen here recently, which Richard pointed to, is the ESOP world. And it really has become more of an education in the market and a more popular transition of the company. And the reason for that is because of that education. People just didn't understand them. They're very complicated. And it has changed here, especially in Central Ohio over the last, we'll say, 5 years or so. And again, for everybody's benefit, ESOP, employee stock ownership plan, it is a way for the owners of the company to transition the shares of the company to the employees of the company over time. So the great part about it, it goes from a taxable entity when it's done that way previously as an S Corp or C Corp, and then it's going to move into a taxable free entity at that point. So now you've just created a company that is now owned by the employees, and it is a tax-free entity to allow it to build a war chest, prepare for what retirements, acquisitions, et cetera, going forward. The other big benefit that people are really liking about the ESOP today is culture is more important than ever. And what it is doing is it allows a company to preserve that culture that they've built over the lifetime of that company. I've seen ones where, hey, I've built this company up over 80 years. I want to see it hit 100 years and have the same name on it. Well, if you go different routes, maybe a PE firm or a strategic or a financial, that might not be the case. It could get absorbed in, become a wholly owned subsidiary, change the name. Through an ESOP, you know that's going to get carried on thereafter. And they're set up so that the owners are paid out over 5 to 7 years from the date of the transfer to an ESOP. And the great part is they're still able to work in that organization. So the owner can still work for another 5, 10, 15, 20 years, whatever they'd like going forward. And it's that education of all these factors in the recent years that's become making it a very more popular choice of a monetization of a company here going forward.
Yeah, Andrew, I would agree with that. It used to be, in the space that I worked at, we didn't really see very many ESOPs. And that conversation is starting to happen. We actually just closed one about 3 weeks ago. So it's even coming down to the smaller size companies. So it is more and more popular. The one thing that I would add also, especially in that smaller 25 million and under space, SBA is a vehicle that you will likely hear from your bank or a buyer that's coming to the table to buy your company as a very viable option. So there are a lot of deals done via the SBA. Reason being, as Andrew mentioned, you're paying a multiple over EBITDA, right? Well, there's not always collateral, to support that number, right? And so, banks lend on cash flow, but we also lend based upon, from a secondary perspective, are we covered? And so that SBA guarantee allows us to be a little bit more aggressive and lean into some transactions and stuff that maybe we wouldn't otherwise be able to do. So, so be aware of that. If you're selling or buying, that is something that we see our customers utilize on pretty much a weekly basis. We seem to be a lot of merger and activity going on out there in the marketplace right now. A week doesn't go by where we're not either talking about a new one or closing on an existing one, it seems like. So the market is very hot. So if you're not in that market or you're interested, just certainly get your feet in there and start looking around. There's a lot of good things. There's a lot of generational wealth that's going to transition over the next 10 to 15 years. And we're starting to see that. And so the last thing we want to see our clients do is today say, I want to sell my company, and they've done nothing to prepare for that. So, I think that's the key thing. If you take, and that's not a quick process, by the way. If you decide I want to sell, you may need a year or two to position the company to get the best value out of it. So be communicative with not only your bank, but also your accounting and attorney partners that you work with to really help prepare that company for sale. And I think you will see a drastic difference in the price that that company would sell for. So.
Steve, I couldn't agree with that anymore. I want to get back to that. I have a comment regarding that. And also I would like to ask you a little bit more about SBA lending. Andrew, I want to go back since we've got people in here, small business owners and others, and they're very, very busy. So they don't always hear all of the terms that we're using today. I know it's a common term, but you used EBITDA several times. Can you please just tell them what EBITDA, what it is, what it represents, and how it's calculated?
Yeah, absolutely. Your earnings before taxes, interest, depreciation, and amortization. And it goes back to exactly what Russ was talking about earlier. It's the lifeblood of a company. It's going to show you the true cash flow. So that is what is really going to be the true value or the driving force of one of the factors of what the value is derived off of. So finding that and understanding what that EBITDA is, the earnings before interest, taxes, depreciation, and amortization, is very important, understanding that calculation and what your company is. Another point on top of that, when you are going through and looking at what a company is worth, there will be something called add backs. And that'll be called add backs to your EBITDA. And there's things that you can take and put back into EBITDA that are not necessarily required to run the company. For instance, if it's a lifestyle company by the owner, you got a $70 million company, $7 million EBITDA, but the owner is using it as a lifestyle company and, hey, I've got my cars through here, I've got these other things, I've got an exorbitant salary. Those are things that can be added back to the EBITDA to further increase it for the value, because anybody else owning the business would not need those things to run and operate that business going forward.
Thank you, Andrew. And I'd like to say that it's been mentioned, but positioning your company for a succession. The team here has mentioned there's various ways of achieving that succession, whether it's a sale, a gift, an ESOP. There's multiple avenues to go there. But one key thing, if it is going to be one of the avenues that is generating a sale price to generate your retirement fund, you need to prepare years in advance, several years in advance, which has been mentioned. And what that means is to ensure that you have not just are profitable, but that you have leadership teams, that you have infrastructure in the company, so that your company is going to be worth more when you go to transfer that, when you go to sell that, if it can run without you, if it has leadership at every area that it needs to have leadership, that it has great banking in place, it has great insurance in place, it has a great legal, everything about your company has been strengthened. That maximizes the value of your company when you, let's say, use the term go to market. Okay, and then Steve, just real quick, SBA, I know Huntington's huge in the SBA, one of the largest SBA, maybe the largest, I can't recall, in the United States. But so you mentioned some SBA. Are there any other key points anything else you want to throw in regarding SBA lending? I know during the pandemic, it could have been nice to have an SBA loan because some of your payments were, that was another area of forgiveness during the pandemic.
It was, although I wouldn't advise taking an SBA loan hoping that the government's going to make your payments for 6 months. But yes, that was a nice feature. The one thing that I will say about SBA, and I know in the business circle sometimes SBA gets a bad name or a bad rap. Things take too long, and all of that can be true. But I would tell you that if you work with an institution that knows SBA and how to facilitate them, at Huntington, we can facilitate an SBA loan almost as quickly as a conventional deal. And so what SBA really allows us to do is maybe what I would say, stretch a deal that maybe couldn't be done conventionally might be a perfect SBA opportunity. So be open-minded to it. We do see a lot of they do have some flexibility in terms of equity that needs to be put into transactions. Sometimes you may be able to put, I've had deals where they put very little money into it. And the owner that is selling maybe is holding a note and playing a little bit of bank. And so there's just a lot of flexibility with the SBA program that you may not see on the conventional side. There are certainly some very stringent rules around certain pieces. But there is some flexibility there, and it allows us to do transactions that maybe wouldn't be done without an SBA support. So, things without, collateral, those types of things are shored up with an SBA guarantee. If you have, a company that maybe has concentration to a particular client, a lot of times that's something where, a conventional deal, you're just not comfortable, because if you lose that one client, then what? Does the company exist? And so SBA can lean into some of that stuff a little bit better than we can on the conventional side, and it adds additional support to get the deal done. So,
Steve, do I have this right? Are there also, is it within directly associated with SBA that there are programs to assist, let's say, minority businesses, female-owned businesses, et cetera?
Yeah, I'm by no means an SBA expert. There are many SBA programs, and there are certain aspects that lean into those. Military as well is a big one. It's not a reason to do a deal or not do a deal, but they very much lean into a variety of those factors for sure.
Yeah, so as
And
you
I-
point out, I know sometimes there are people who are kind of dissuaded from an SBA because they think it's going to be a lot of time, effort, and money. But there are some really good instances where an SBA loan is the perfect fit. Russ, was somebody getting ready to say something?
Yeah, I was just going to say there is a problem. We call ours Lift Local, and it's a program that we run through the SBA where we target specifically underprivileged demographics and neighborhoods, and we're very aggressive in our underwriting, and SBA has bought off on that, and so we work hand in hand with them to do it. We actually budget about 30% of the dollars that we send out the door to be charged off. That's how aggressive the underwriting is with that. And I've seen those loans go for the lady who's renting a chair in a salon to open their own salon, to give them the funds to get going. Those are small loans, but they're targeted, like you say, to those special groups that maybe don't have access to capital, and we're trying to get them some capital so they can help lift themselves up and create great CPA clients in the process, by the way. So that's part of what we do. And I would say Steve didn't jump up and raise the banner, but we are the largest producer of SBA loans in the country by unit. We have been for 3 years, and we have every intention of staying there with our focus on what we do. It's a great way to get capital out in the markets that we try and serve, in the neighborhoods and the towns and the villages that we serve. So anyway, it's a great program. I worked for 2 other large banks that would claim great prowess at SBA, and just from an insider's point of view, they don't know anything compared to the way we do SBA at Huntington.
It's good to know, Russ. Thank you. Jacob, do we have, I don't see any questions that have been presented.
No, we have not had any questions. If anyone would like to ask a question, feel free to type it into our chat. Concerning closing statements, I do want to announce next month's workshop. So next month's for the May workshop will be on HR compliance and considerations. Invitations and information will be sent out in the coming weeks, so stay tuned.
So any participants have any comments or questions before I'll tell you what, while you're thinking, I'm going to throw one more out there. How are your underwriting departments doing right now? I'm assuming with everything going on, things are tightening up a little bit. They're being a little more choosy.
Yeah, I mean, I guess in the business banking space, I would tell you we are very busy. What we consider our smaller end, the scored end, is particularly busy, and frankly a little backed up. But yes, I mean, obviously we underwrite to risk, right? And interest rates are rising, so we're stressing everything that comes in and making sure that we can go through the wave cycle a little bit. But by and large, we're trying to find ways to do deals and get capital out into the market. So this isn't the first time interest rates have risen in the history of the banking world, right? So we have experience lending into it, and so we certainly will stress deals, but it's no different than any other time in history, I would say.
Let's just not revert back to, I believe it was the 70s. I think we had like 18%, 20%, something like that. So we are, let's see here, Jacob, we've got a couple comments. Any questions? Nope, we have a couple of comments thanking you, gentlemen. You have done a fantastic job. We really appreciate all of the information and expertise that you have shared today. And if anybody who's participated have any questions for any of our panel discussion experts, let us know. You can reach out, or hopefully it has generated something that you would reach out to your own present banking partner that you have. But this was meant to educate and assist and help you through all of the changes that we are all experiencing today. So thank you to everyone. We appreciate it and hope you have a fantastic day.
Thanks, Richard. Thanks, Jacob.
Thanks, Richard. Thanks, everybody.
Thank you.
Thank you.
Everyone. Appreciate it.